Coffee first. Peter Rose, Longwood Currency Trading. How to exit a Forex position for maximum profit. A lot of people will say, we'll set a profit target that's reasonable, and when the price gets there, kick out. It's more than that. More in the sense of taking the entire position life cycle into consideration, and not just what you're going to do 15 seconds before you pull the trigger. Trading, in this instance, is a lot like playing pool, where you look at the position of the balls and where you're going to strike now, and then where the balls are going to be after you do that strike to set the next strike, set the next strike up. It's not sufficient that you only look at the one thing that you're trying to do, which is exit the position for the profit. You have to look at how everything is setting up around that position to maximize those profits. Now, you would think that would be part of the entry analysis of the life cycle of a currency pair. Entry analysis, position management, and then exit methodology. And we're talking about the exit methodology phase now. Why isn't setting the profit target your exit methodology? Because that has nothing to do with exit methodology. Setting the profit target is part of whether it's worth taking the trade or not. If you don't have enough pips, the price doesn't have enough volatility, it's not Tuesday, or whatever factors there are that you're determining what your entry criteria is going to be, the fact that you're setting an exit point doesn't make that the point that you're going to get out of the trade. Any more so than if you're looking at a pool game and you're going to say, well, I'm going to try to get all the balls in the pockets. You have to, from a probabilistic view of price action and an estimation of the volatility of price when you go in, you're asking yourself, does price have enough momentum to get from where it is to some distance? Now, whatever that distance would be, and that distance is a distance prior to losing momentum to the extent that the retracement is more than you'd want to sit around for. If you're a long-term position trader, that swing could be 30 pips. If you're a day trader, that swing, anything over 5 or 8 pips is too much. You've got to really be careful about how you look at entering a position and what its likelihood for success is going to be, so that you could withstand maybe 2 losses against your short entry stop to make that one large gain, or 2 large gains, or 4 smaller gains to make that up. It all has to do with your win-to-loss ratio, your average win value, and your per trade expectation value. That's why having a couple of hundred trades of good, solid trading in order to establish those metrics is really important for you. And once you establish a valid set of metrics, they're not going to get worse, because you're not going to get to be a worse trader. They will get better, but it doesn't matter if they get better. If you just concentrate on those really good, solid metrics that you have, anything that you get above that is gravy. It's all in who's teaching you how to do this trading stuff, and how experienced they are in managing these positions and looking at the long run on this stuff. And so just to set an entry stop is insufficient. There are 2 factors involved. One is, what sort of price action am I going to look for to see if price is slowing down and may very well end up in a reversal that's larger than what I'd want to go through. And the second is, if price gets to your profit target, what are you going to do? Are you going to exit, or are you going to manage that trade beyond the profit target? And what are you going to do to manage that trade beyond the profit target? That's readjusting your stop, readjusting your thought process as to where the stop should be, whether it should be a trailing stop, what the criteria is for slowing price, and all that other sort of stuff. That's your exit methodology that you're going through. And that exit methodology is as important as your entry analysis. Because if you have a good trade and it's running in position, I'm writing a computer program right now that is studying the differential between, as you stage in, where the average price is in relationship to the current price. I had a position in working through this stuff where at a certain point I had 10 lots and I was going to stage in 3 more lots. And do you know that position ended up being negative overall for a 13 lot position because I staged at the wrong point. If I would have staged just 3 or 4 pips higher, then I would have got out with what I call a minimum desired dollar value. A minimum desired value, I think I talked about this in the last video, is and I don't put a term to it like that. It's simply, you know, if I'm going to get into a trade and I'm going to risk X amount of dollars, I want the amount of money, dollars, that I make divided by the amount of risk that I took to be at least 1/3%, 0.30%. Not 3%, 0.3%. 3% on a 10 lot is $300. Well, if that's all I was able to get out of the 10 lot, and I could do that 3 days a week, I mean, right? That's about $1,000 a week. That's $50,000 a year. And that's based on a $100,000 account at my criteria level to trade 10 lots. You could trade 10 lots for probably $70,000 or less if the margin requirement on a particular pair that you have is lower. But I digress. If you don't have good entry analysis, you won't have a position to manage. And if you don't have a good exit methodology, then all of your entry analysis and position management was a waste of time, because you don't know how to effectively get out of the position with a solid enough return to justify taking the trade and putting that money at risk. And so I just want you to be aware that the reason that I broke the trade cycle up into these 3 phases, that comes right out of my software engineering background, 33 years of software engineering, where the life cycle of a computer program, as you're developing it, has different phases that it goes through. And as long as you stay on those phases, you've got a path to success. Once you get off and you don't have phases and you're just throwing shit against the wall, you end up with a horrible mess. Whether it's a computer program or whether it's a FOREX currency trade. And so it's so critical for you as you're building your trading plan to properly consider, what are you going to do with the profit target that you set? Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.